A lot of real estate investors are about to discover something uncomfortable. They don't actually own assets, they own obligations pretending to be assets. And the difference between those two things is going to define the next decade of American real estate. Because despite what headlines say, the real estate market didn't fail, the rules changed, and a lot of people are still investing like it's 2016. They still repeat phrases like, real estate always goes up, just hold long enough, buy and wait. But those weren't timeless investing principles. They were side effects of one of the greatest financial tailwinds in modern history. Falling interest rates, cheap debt, cheap insurance, abundant liquidity, and population growth almost everywhere. That environment made mediocre assets look brilliant. Bad operators survived, weak markets survived, terrible deals survived because time covered the mistakes. Now time is exposing them. And that's where things get dangerous, because there is no single real estate market anymore. There are now two completely different systems operating under the same label. One market compounds wealth, the other quietly destroys it. And most owners don't know which one they're in until liquidity disappears. That's the part nobody wants to talk about, because the real danger isn't a dramatic crash. Crashes are obvious. Crashes make headlines. The real danger is stagnation combined with rising cost structures. That's how wealth actually gets erased in real estate, slowly, quietly, through taxes, insurance, deferred maintenance, regulation, shrinking buyer pools, and trapped equity. You still own the property, but it stops doing what you bought it to do. That's why institutional capital changed behavior before retail investors did. Watch what the smart money is actually buying right now, not what people on social media are saying. Institutions are no longer chasing hype, they're chasing survivability. That's a massive shift. When large funds buy real estate today, they're not just asking, will this appreciate? They're asking, will this still be insurable in 10 years? Will taxes outpace rent growth? Is this market driven by actual economic expansion or nostalgia and migration momentum? Can this asset survive higher capital costs? If liquidity dries up, who becomes the buyer of last resort? Those are infrastructure questions, not speculation questions. And that's exactly why certain markets are separating from the pack. Look at Arizona, AI infrastructure, data centers, industrial reshoring, TSMC, power demand, population inflows tied to actual job creation. Capital is moving toward economic gravity, not just cheap houses and sunshine anymore. That's the misunderstanding most people still have. They think the next real estate cycle will look like the last one. It won't. The old model was buy property and let financial conditions do the work for you. The new model is own assets connected to long-term infrastructure, energy, logistics, and economic relevance. Power, water, industry, compute, transportation, jobs, that's where durable value is forming. Everything else increasingly behaves like a liability with maintenance attached to it. And the scary part? Most people won't realize the difference until exit liquidity disappears. That's when they'll discover the market never actually guaranteed appreciation. It only temporarily subsidized bad assumptions, and that subsidy is ending.